Food Oil Development Company Limited has provided the following report in respect of its operation for the year ended 31st December 2010. A. The company produces 40,000 barrels of crude oil per day, of which 85% is sold into the export market. The remaining was sold to the local market. B. The crude oil produces an API gravity of 31 degree. The standard API of 36 degree attracts a price of 45 naira in the export market. It has been agreed that for every degree rise or fall in the API gravity, price will be amended by 20 kobo. The posted price for the local market was 8 naira 50 kobo per barrel. The company delivered 900,000 barrels to the refinery out of the volume available for the local market. The refinery, which has a capacity of 50 million barrels, was completed at a cost of 15 million and is to be depreciated at 5% per annum on a straight line basis. The cash of maintenance was 700,000 for the cost of maintenance was 700,000 for the year. It was also reported that the cost of transportation through pipeline is 1 naira 50 kobo per barrel. The opening stock was 46. The opening stock of crude oil at the beginning of the year was 46 million, while the closing stock at the end of the year was 71 million naira. F. Expenditure incurred by the company. Look at the list of expenditure, and they said the company entered into a gas contract with company in Sicily, Italy. The contract worth 4,750,000. The load factor of the gas was recorded as 59 degree. The next one, the laws brought forward are given in the question, while the schedule of qualifying capital expenditure are also given in the question. So based on the question, we have to compute the tax liability for Food Nigeria PLC. So, and in order to compute the tax liability, you have to follow the format I gave in the previous lecture. So the first thing I'm going to do now is to calculate the total income. And before you can calculate total income, you have to calculate the export sales, you have to calculate the domestic sales, the value of oil disposed, and the value of natural gas. So in this question, it is said that 40,000 barrels were sold in a day. So definitely for a year, 40,000 barrels times 365 days will be sold. That's 14,600,000 barrels. So for export sales now, for export, in the question they said 85% was sold into the export market. So we'll use 85% of 14,600,000 barrels. So that gives us 12,410,000 barrels. To get the adjusted posted price now, so we've gotten this, it remains this adjusted posted price. So the posted price in this question is 45 naira in the export market. Your standard API gravity is 36 degree, while the actual API gravity is 31 degree, which makes a difference of 5 degree. So the change is now, they said it has been agreed that for every degree rise or fall in API gravity note, price will be amended by 20 kobo. So you multiply this by 20 kobo. So price amendment now, 20 kobo times 5 degree, that will give us 1 naira. So I'm going to deduct this 1 naira because the actual API gravity is lower than the standard. Assuming the actual API gravity is higher than the standard API, I'm going to add, but in this case I'm going to deduct. That's 44 naira. Are you getting it now? So I'm going to multiply the 12.41 million, that is 12,410,000 barrels, times the adjusted posted price, which is 44 naira. That's 546. So remember, in this question, the name of the company is As Food Development Limited, and we are computing of tax liability for 2010 year of assessment. So the first thing, so we have export sales. Based on what I calculated here, 546 million is 040. So it remains local sales. Now, in this question, they said 85% of their production, 85% of this production was sold export, and then I said the remaining was sold to the local market. So to get for local market now for local market sales, the remaining 15% of 14,600,000 barrels will give us 2,190,000 barrels. And if you go to the information D, the information D says that the company delivered 900,000 barrels to the refinery out of the volume available for the local market. Definitely this 2,190,000 barrels is not the local sales. They even transfer out of this to the refinery. So in order to get for local sales now, you are going to deduct 900,000 barrels from this. So you say minus 900,000 barrels. So we will have 1,290,000 barrels. And information C, they've given us the local market, the selling price per barrel, the posted price for local market. So for local market now, we will now have 1,290,000 barrels times, so the selling price is 8 naira 50 kobo. That's 10,965,000. So you write it there, local sales, 10,965. So we've calculated crude oil sales. The next thing is we calculate our value of natural gas. So remember that in the last class I gave us some minutes, I gave us some percentage for gas factor and oil load factor. So in my last illustration, I talk about the value of natural gas. So I also taught us how to determine the value of natural gas by giving us some percentage which are the gas factor and some load factor, and I told us how to compute for the gas factor if the load factor can be traced directly, like this. I give us something like this here. So that is how we are going to calculate the gas factor and the load factor. So based on this question, if you go to information, the question says that the company entered into a gas contract, information G. The company entered into a gas contract with a company based in Sicily, Italy. The contract worth 4,750,000. So in order for you to compute this, the first thing you are going to compute is the gas factor. So to get the gas factor now, the load factor is 59 degree. So 59 degree, we can trace 59 degree, we can see it's between 50 to 60. So 59 degree, the 50 degree is 16.9%. 16.9%. So the remaining 9 degree, you now multiply it by what is the percentage. The percentage of 50 degree, we have 16.9. Then the percentage of 60, we have 15.5 degree. Simply because 59 degree is between 50 to 60. Are you getting it now? So you write the percentage of this is 50, then the percentage of this is 60. So we have minus 1.26. So this gives us 15.64. So this is the load, this is the gas factor, 15.4%. That's for 59 degrees. So to get the amount, the value that we are going to apply for the purpose of computing PPT, that's the value of natural gas sold minus the allowance. So the value of natural gas sold is 4,750,000 naira. So the allowance now 15.64. So 15.64% of that 4,750,000, that's 742,900. So you deduct, that's 4,007,100. So you write it down, 4,007,100. Now the next thing in the format is the computation of value of oil disposed. And in my last class, I told us that for you to calculate the value of oil disposed, the company would have transferred some portion of the crude oil to the refinery. Without transferring to refinery, there is nothing like value of oil disposed. There's nothing like value of oil disposed. So, and I told us that the value of oil disposed comprised of three things in my last lecture. I said value of oil for royalty purpose, that's one. I also said maintenance cost, and I said transportation cost, which are those three things that you compute based on this question. So in information D, they said the company transferred 900,000 barrels to the refinery. That is this 900,000 barrels that you deducted here, because we saw it in information D. So let's compute that. So value of oil disposed now. So the first thing we are going to calculate is value of oil for royalty purpose. To value of oil disposed. So, and I gave us the formula on how to calculate so the formula is barrels transferred to refinery times adjusted posted price. So the number of barrels transferred to the refinery is 900,000 barrels times the adjusted posted price based on this question, based on what we calculated, is 44 naira. So we have 39,600,000. The second one is maintenance cost under this. So based on the question, they only gave us the maintenance cost, the cost of maintaining the whole factory, not the cost of maintaining that portion transferred to the refinery. So since the portion, the maintenance cost they gave us is for the whole refinery, definitely we are going to apportion it. And I gave us a formula for us to apportion it in our last lecture. So, and I said the formula is number of barrels transferred to refinery all over total capacity of refinery times maintenance cost. So based on this question, the number of barrels transferred to the refinery is 900,000 barrels. And the total capacity of the refinery is 50 million. Times the maintenance cost. Based on this question, the maintenance cost is 700,000. That's information D. So the price is 12,600. The third one is the transportation cost. So based on this question, the transportation cost is $1.5, 1.5 naira per barrel, 1 naira 50 kobo per barrel. So that's, you multiply the 900,000 times the 1 naira 50 kobo. So we have 1,350,000 in total. So if you now add those three, 1, 2, and 3, we have 40,962,600. So that's what we are going to write here. 40,962,600. So we will total everything to give us our total income. So the total income here is 601,974,700. So that's the total income. So remember, in our last class, the next thing that I wrote is, under the format I wrote, we have a closing stock, we have production cost, we have transportation cost, and we have opening stock. So based on this question, in information E, they said the opening stock of crude oil at the beginning of the year was 46 million. So the opening stock of crude oil is 46 million. And the closing stock is 71 million. The production cost, if you look at information F, they've given us the list of expenditure incurred by the company. You see production cost, which is 148,500,000, and you see transportation cost to be 17,350,000. Now I know some people will be wondering why I deducted opening stock. Based on tax rule, for the purpose of computing PPT, closing stock should not be deducted. Opening stock should be deducted. That's for Nigeria. Are you getting it now? So for the purpose of computing petroleum profit tax in Nigeria, opening stock will be deducted and not closing stock. Are you getting it now? So the reverse is the case for petroleum profit tax. So to get this now, we have now, in our last class, I've given us the list of allowable expenses and disallowed expenses. But for the purpose of examination, to some extent, it's going to be difficult for any student to understand all allowable expenses and all disallowable expenses. For you to understand the allowable expenses and disallowed expenses depends on the number of questions you treat. If you treat many questions, you'll be able to meet number of expenses that are allowable and disallowed. And another thing is, there is an acronym, WREN, wholly reasonable, exclusive, and necessary. If an expenses is to be incurred, and if the tax authority is going to accept the expenses you incurred, the expenses must be wholly reasonable, exclusively, and necessarily incurred by the company, and the tax authority will find it reasonable that you incurred this type of expenses. So for you to understand allowable and disallowable expenses, treat as many questions as possible under this petroleum profit tax so that you will understand more. You can also browse more list of allowable expenses under petroleum profit tax and you can get further. So for the purpose of this question, in our information F, they've given us list of allowable expenses. We have depreciation. Of course, we know that depreciation is not an allowable expenses. The next one, we have intangible drilling cost. Intangible drilling cost. So we have it to be 1,650,000. The next one, we have cost of 4 appraisal well. So under the allowable expenses, the only appraisal well that is allowable by the government is 2 appraisal well, not ordinary 2. The first two that you dig, that is what government is going to allow. So cost of 2 appraisal. So we have it to be 80 million, so we divide it by 2. So you say 80 million divided by 4 wells times 2 wells. So we have it to be 40 million. The next one, we have rent to be 12 million. Then we have custom duty to be 7 million. We have non-productive rent. Both productive and non-productive rent are allowable. You can see that on the previous video. I sent some list of allowable expenses and disallowed expenses there. Royalty on exports. Both royalty on export sales and local sales are allowable expenses. Royalty on crude oil sales, on local sales, they're allowable. So that's we have 5 million and 800,000 respectively. 5 million and 800,000. The next one is traveling and transportation. Now, if you discover that under PPT we have 3 transportation costs there. The transportation cost you calculated when you are calculating your value of oil disposed, that's one. Another transportation cost is here. Another transportation cost is here. Do not make mistake of interchanging them. They have different meaning. Now, under normal scenario, this transportation cost will be under allowable expenses. This one here. But the transportation cost under the value of oil disposed, you are the one that is going to calculate that yourself. And why this one will not be called transportation cost alone. It's going to be called traveling and transportation cost. So that's one of the hints on how to get which type of transportation cost you are going to use for in any of these 3. Are you getting it now? So the traveling and transportation cost is 3 million. We have the production cost, we've used it. Transportation, we've used it. Salaries and wages. We have 150,500,000. We have admin expenses. To be 89,750,000. Interest on loan, 2,630,000. Bad debt written off we have it to be 3,500,000. Now the next one is education tax. Remember I told you in our last class that education tax is an allowable expenses which will be calculated separately. So the next thing is to calculate my education tax. It's the computation of education tax, because without this education tax you can't get the total allowable expenses. So in order for us to compute the education tax, remember in our last class I showed us how to compute education tax like this. That is adjusted profits before ET, education tax, loss relief, balancing charge, stuff like that. And based on my question here, I will have to determine my adjusted profit first. And now for me to determine my adjusted profit is gross profit which is 411,124,700. And pardon my manners, based on what I calculated here, I've made some changes. Here I added before, so I deducted it, so I noticed the answer was not correct, so I deducted it. So this is the real result, 190,850. You can press your calculator for more confirmation. Then you deduct, you give us this 411,124,700. So the principle still remains the same. Add this, then deduct the opening stock. Are you getting it? So allowable expenses. So the addition of all these allowable expenses, everything is 317,830. 317,830,000. So this is the adjusted profit before education tax. So the next thing is my loss relief. Now based on this question, if you go to information G, they've given us a loss relief. Sorry, information H, they said loss brought forward as follows. They've given us the list, and based on the rule I told you that all losses can be relieved indefinitely for the purpose of PPT. So you relieve all losses. That's total is 33,694,100. So there is no balancing charge. There is no balancing charge here in the question. So I skip that. So we have 59,600. So this is assessable profit before education tax. So your education tax is 2/102 times 59,600,600. That's 1,168,639. So we now come here. We write 1,168,639. 39. So you now add everything together. Remember, I've added all this before, excluding the education tax. So I will now add education tax to it. So if you deduct the two, it gives us adjusted profit. So the next thing in the format is the loss relief. Remember that the loss relief that I deducted here is just for education tax. So you now deduct the loss relief, the real loss relief, this value 33,694,100. Remember, there is no balancing charge. I should have write balancing charge, but I don't have balancing charge in the question. So this is your assessable profit. So if you want to know, to confirm whether you are correct or not in the computation of your education tax, if you do 2% of this, 2% of this must give you this value. And you see, 2% of this must give you this value. If the 2% did not give you this value, that is the education tax, cross-check what you've inputted and cross-check your calculations very well. So for proper confirmation. So that's one step ahead. So the next thing is the capital allowance. Remember I said capital allowance is lower of A, total capital allowance, and B, 85% of assessable profit of 58,431,961 less 170% of investment allowance. So let's calculate the capital allowance first. So, and I told us that in computing capital allowance, capital allowance is 20%, and we only have 4 classes of qualifying capital expenditure under PPT, and I gave us last week, that is this note. I gave us this note last week. I said we have annual allowance, investment balancing allowance, and unrelieved capital allowance brought forward. I said there's nothing like initial allowance in PPT, and I gave us the list of QCE under PPT. These 4, anything apart from these 4 are not QCE. So, and I said the annual allowance is 20%, which is 5 years. That is the first 4 years is 20%, while the remaining, the 5th year is 19%. That is 1% will be withdrawn by the tax authority. So let's calculate the computation of the capital allowance. So remember, you first calculate your annual allowance. So pipeline, the year it was purchased is 2010. So that's the first year, and it is 20% of 15 million, which is 3 million. So we have pipeline to be 2010, So remember, you are computing for 2010 year of assessment here. So that means that's the first year to 2010. So pipeline in 2000 and they bought it in 2006. That's the 5th year. So that will be 19% of the total figure that is in the question. Tanker 2009, 2nd year, 20%. So building is in the 6th year, 2005. That's 6th year. So no capital, no allowance for that one because that's the 6th year. Others 2008, that's 3rd year. So you add everything, you do the 20%. So you add everything. So for investment allowance now, remember investment allowance is once in the lifetime of a qualifying capital expenditure. So investment allowance will also be charged in that year that the asset was purchased. Remember, you are computing for 2010 and the only asset you purchased in 2010 was pipeline. So we are going to calculate investment allowance. And in the last class, I gave us some percentage for investment allowance. I said I give us for investment allowance, I give us offshore and onshore. Onshore means on the ground, while offshore means inside the ground. So if it is onshore, we have 5%. Offshore, this is it. It depends on the depth. 0 to 100 meters, 101 to 200, 201 above, like that. So, and for this purpose, the asset here that was purchased in 2010 was located above 200 meters. Are you getting it now? The asset was located above 200 meters. So pipeline, that's 20% of 5 million. So for above 200 meters is 20%. So we have 3 million. So this is the total capital allowance. Since we did not have balancing allowance and we did not have capital allowance going forward, so the total of this is 6, 13. So we have 24,380,000 plus 7.98 plus 3 plus 10.4. That's 24,380,000. Total will now be 27,380,000. So this is the investment allowance, which is 3 million. Remember this 3 million, and remember total capital allowance 27,380,000. So 85% of this then 170% of 3 million, that's 5 million. So this gives us 44. So the lower, this is the lower. So you deduct this, you put this here, 27,380,000. So you deduct. Then we have chargeable profit. So the tax liability now, petroleum profit tax, we have 85% of 31,051,961. Then if you have memorandum of understanding, MOU, you deduct it. So we have 26,394,167. Since there is no MOU, so your education tax, the one you computed earlier, this here, 1,168,639. So that's all for PPT. So you can see that it is very, very simple to understand. Very, very simple. If you can understand those logic behind it, those points, like this is the first point, how to determine the total income. This is the second point, the third point up to this stage, then the education tax and the capital allowance. That's just all. That's all what you need to understand. So I'll take another illustration, a different illustration from this, where the petroleum profit has been computed. So we just have to recompute based on the tax view. So thank you. If you have any question, feel free to let me know, and don't forget this amendment. Don't forget this amendment that I made. So thank you very much. May God bless you.